Hello students and welcome to this lecture on Ifrs 9, which is called Financial Instruments. The quote for this week says, "It's not the will to win, but the will to prepare to win that makes the difference." And that was a quote by Paul Bryant. I love this quote because it reminds us that there's a difference between a dream and a goal. So a dream is just something that you would like to achieve, but you don't show any action towards it. While a goal is a dream with a plan for which you prepare. And I think it's very important to understand the difference if you want to be successful. So as I said, today's lecture covers Ifrs 9, and Ifrs 9 attempts to do something which is quite difficult, and that is to tell us how financial instruments can be measured and how they should be accounted for. Financial instruments, or the term financial instruments, is an umbrella term, and it basically refers to three different things. Financial assets, financial liabilities, or a combination of financial liabilities and equity. So where a financial liability and the equity forms one type of instrument. So just again, I made a summary just to show that if we are working with financial instruments, we are talking about a financial asset, a financial liability, or a hybrid instrument. So for a hybrid instrument, it is the combination of a financial liability plus an equity. And this is also called a compounded instrument in some textbooks. Right, so let's look at what it means. So there's a definition for a financial asset as well as a financial liability. But in short, a financial asset means that you have a cash or you've purchased an equity instrument of another entity. So if you are A Limited and you buy shares in B Limited, that's a financial asset. It can also be the right to receive cash or another financial asset, or to exchange financial assets or financial liabilities under a condition which is favorable to the company under review. Then a contract that will or may be settled in the entity's own equity instruments and is a non-derivative or a derivative instrument. So a financial asset basically means that you take money and you invest in a financial instrument issued by another entity. So this can be their equity shares, their preference shares, bonds that they've issued, debentures that they've issued. So you buy this bond, this debenture, this share, and you plan to keep it for different reasons. In one instance, it might be inventory, so where you trade with financial assets. For example, you sell the shares of other companies to get a gain, and it's your day-to-day business. It can be for other comprehensive income, for example, where you have a normal type of business and then you trade with financial assets of other companies on the side and you speculate. For example, you have a company that sells groceries, right? But then also as part of its business on the sideline, it just sells financial assets when it sees that, for example, the shares that they've purchased has increased in value. So financial assets, that's the definition. It's either an equity instrument, and it leads to a contractual right, because if you have purchased a financial asset, so if you purchased the shares of another company, you get the right to a dividend. If you've purchased the debentures of another company, you obtain the right to the interest that they pay to you. So that's where the contractual right comes in. A financial liability is the opposite. So that is the contractual obligation to deliver cash or a financial asset to another entity, or to exchange financial assets and financial liabilities under conditions that will be unfavorable to the business. Again, there's a contract if there's a contract that might be settled in the entity's own equity instruments, and these instruments may be non-derivative or derivative. So again, in short, this is where your company issues shares to another business or another party, can be a natural person as well. Here, It can be where there's an issuance of debentures to someone else, an issuance of bonds to someone else, an issuance of preference shares, an issuance of ordinary shares to another individual or legal person. That's a financial liability. Again, it carries an obligation, a contractual obligation now, not a right, but an obligation, because now you will have an obligation to that party to pay them a dividend, to pay them interest if it's a bond or a debenture. So there is an obligation that is attached to a financial liability. You will also see that we have this concept of a hybrid instrument or a compounded instrument. And there I said it is when you have a financial liability and an equity together in one instrument. And the only thing I could think about to explain this was actually a movie that I've seen, and it wasn't a very good movie, but it is called Jurassic World. And in Jurassic World, I think there's a Jurassic World 2, but I didn't see the sequel because the first one was quite bad. So in Jurassic World, they take the genes of different dinosaurs and they put them together to create new monsters. And I thought that really translated well into what they've done here. So they've already taken financial liabilities and equity, which is quite a large and difficult topics on their own. And then they kind of stuffed it into one instrument. So hybrid instrument needs to be split, and one part of it is a liability and the other part of it is an equity. When do we have a hybrid instruments, or why do hybrid instruments exist? Well, they exist because of options, right? So I'm just going to make that note. I think it's important to remember. Hybrid instruments exist because of options. And this option is that when a financial instrument is issued, it can either be matured and you can pay the person in cash, or they can get shares. So I think there's also examples like that in earnings per share, where, for example, you can decide on maturity date, you can get 2 ordinary shares for every debenture that is held. So the option can be at the issuer or the holder. But the option is you can get money or you can get a number of shares, ordinary shares, preference shares. So I've created an example here just to make sure that we are on the same page. So an example of a hybrid instrument is this one where it says G's Limited issues 2,000 10% bonds at a cost of 500 Rand per bond. The issue date is 1 January 2021. The maturity date is 31st December 2023. Each bond is convertible into 2 ordinary shares for every bond held on maturity date. This option can be exercised at the option of the holder. So this sentence makes it a hybrid instrument because they have an option. At maturity date, they can take 2 ordinary shares for every bond, or it will be paid out to the person in cash or to the legal person in cash. Then they say that the market rate for similar instruments will be 13%. And on 31st December, the holder did not exercise the right of conversion and the holder was paid out in cash. All right, so let's explore the journals to be done. But first, calculations need to be done. So what is important here is to remember that if we do Ifrs 9, it's very important for you to firstly have a financial calculator, and secondly, you need to know how to operate it. It's quite important that you know how your financial calculator works. So if we have to type in the information into the financial calculator, we're going to have our future value, and that is basically the maturity amount. How much is the amount that we have to pay to the holder of this debenture or this bond? I beg your pardon, I think it was a bond. Yes, of this bond in future. Well, they buy 2,000 shares at 500 Rand. So we will have to give them their money back. So for the future, we're going to say it's 1 million Rand, which is then this amount. Just make sure we understand, 2,000 times 500. So that came from saying 2,000 times 500. Then the time, we have to count between the date of issuance and the date of maturity. And by the way, this calculation that you see here is called a yield to maturity. So here we have to go and count. When was it issued? 1 January 2021. When does it mature? 31st December 2023. So the first year end will be December 2021, December 2022, December 2023. So there's 3 years for which the bonds need to be held before they mature. So the 3 I filled out there. Then the I must be the market rate. It's also known as the effective interest rate. And it is the rate at which bonds will be traded for. Similar bonds will be traded for on the open market. Then the payment is the future value times the actual percentage carried by your instrument. So it is a 10% that the business, which is G's, offers, and therefore we take the future value times that 10%. Then you have to compute your present value, and by doing that I got to 929,165 and 42 cents. All right, then we also have to go and calculate the interest. So this is under your amort function. So if you want to know where this was found, it's under amort. So it's under your amort table, and this will be amort 1, amort 2, and amort 3. So amort 1, and these amorts run in terms of dates, and these dates are determined by the date of issuance. So it runs in accordance with the date of issuance. And you will see the date of issuance was 1 January. So the first amort, so the first year end will be 31st December 2021. So that's how we know what the dates are on this amortization table. And I've just copied all the interest. So I said amort 1 to 1, amort 2 to 2, and amort 3 to 3. And I was able to calculate all the interest that is required for this question. Right, so once we've typed it into our calculator, then we can do the journals. So for the journal, we're going to start by saying this is a financial liability. And how do you know that it's a financial liability? Well, because there's an issuance. They say this business issued bonds. If it was that they purchased the bonds, then it would have been a financial asset. But it cannot be a financial asset if we work with hybrid instruments, because a hybrid instrument is a financial liability and an equity. Right, so going back to the answer or the solution, we're going to increase the bank, and the bank is increased by the future value that we typed into our calculator. Then the financial liability is the present value calculated on the calculator, and then you will find that the debits and the credits on the issuance date is not balancing out. And then the difference we call equity option reserve, and the equity option reserve represents that there's an option between getting equity, which is the shares, or taking the money. So the value of the option should be your balancing figure here on the credit side. So this is just a balancing figure. By year end, which is 31st December, we are now booking the interest. So because this is a liability, we have an interest expense. If it's a financial asset, we have an interest income. So the interest expense is calculated on my amortization table. Then the bank amount represents the payment that I've typed into my calculator, which is this payment there. And the balancing figure is booked towards the financial liability. So the difference between your financial calculator's amortization table and the payment from the bank account to the people who purchased some of these bonds it leaves us with a balancing figure booked to financial liabilities, which is represents the bonds. Then we do this calculation again. On 31st December 2022, there is an interest expense. This is again my amort 2. Bank is the payment that I've typed into my calculator. And again, I have a balancing figure here. So this is a good example of what happens when the financial years coincide. So this means that the financial year of the company and the financial year of the issuance maturity date is the same. For the last year, we will then book our interest again. We will show our payment. And again, we will need, should be the balancing figure. This should be the payment that we've made. or we typed into our calculator. Now, at this point, they've said in the example that the holder opts to take the money. So he had two options. You could either take money or take shares. And the holders opted to take money. So at that point, when they've exercised the option, we will, because they've taken money, we will credit the bank with the future value that we typed into our calculator, and we will pay it off against the financial liability. Because once you've paid off these holders, the financial liability can no longer exist because you don't owe them anything anymore. And at that point, the option has been exercised. They chose money. So that option reserve is closed off against your retained earnings. So this option reserve is this reserve that you created there. It was a credit, and to make it go away, we put it in a debit. We write it off against retained earnings. So students may ask, what happens then in circumstances where they opt to take the shares? So in that instance, the only thing that will change is the credit. So the financial liability is still closed off, because once they've chosen the shares, you don't owe them anything anymore. However, instead of the bank, you will now credit the ordinary share capital. If the option is to take up preference shares, you will credit the preference share capital. So this account is the only difference. You will still close off your equity option reserve against retained earnings because an option has been exercised. There should not be an option reserve anymore. You've taken your pick, so no more options that exist to the holders. All right, so that was something interesting. That is called a compounded or a hybrid instrument, where you have an option at maturity date. Do you want money or do you want shares? If we look at Ifrs 9, an important part of it is valuation. How do we value our financial instruments? So valuation means what are they worth in terms of rand or dollar or euro, whatever the currency rate is, where the books or where the transactions of the business happens or the books are set up. So there's two ways to value financial instruments. There's a fair value model and there's an amortized cost model. So for fair value, the valuation can be done through profit or loss and or fair value other comprehensive income. And I am going to explain this because this differs depending on whether it's a financial asset or a financial liability. And the other option is amortized cost. So amortized cost is the calculation that we just did. Amortized cost is where you take your financial calculator and you type all the information into it and you get an amortization table and it helps you do your calculations. So amortized cost is always through profit or loss because there's an interest expense which goes through profit or loss, or an interest income which goes through profit or loss as well. So that valuation will be in the income statement. So I'm going to start with amortized cost. I think it's slightly easier because you have the support of your calculator. So with amortized cost, again, it means amortization is a mathematical function where interest is paid or earned on every new outstanding balance that is calculated. And your financial calculator automatically does that mathematical function. So again, you need your financial calculator to do amortization. So if we talk about amortization, amortization can be applied to a financial asset and a financial liability. For a financial asset, it is amortized cost can be applied if the asset is kept to collect returns, right? So what do I mean by returns? It means that you buy the share of another company or you buy the debenture or the bond of another company, and your main goal is to collect a dividend, to collect interest, or alternatively is just to wait for growth, right? So what many people did last year, the Sasol shares came down in value quite dramatically. And I think you could have purchased a Sasol share for 30 Rand. And at that point, many people bought Sasol shares, right, for 30 Rand. And I think at this point, Sasol shares are like maybe worth, I think, 200 Rand or something. So they've grown literally like 150 Rand per share. So if you buy that Sasol share, it would be a financial asset. And if you keep it for the growth, that's also considered a return. So that 150 Rand growth is also a return. So that's when a financial asset can be kept or accounted for at amortized cost. So financial liabilities can also be recorded at amortized cost, and it's the default method of valuing it. The only exception to this rule is that if the financial liability is kept for trading, but we will have an example of that later on. But most financial liabilities, the default method is you use amortized cost to put it or to account for it in the books. So I've just brought an example of financial assets here. So I've taken two companies and I'm just going to show the calculations if it's a financial asset. So that is the perception of one business, and if it's a financial liability, which is the perception of the other business. Right, so suppose ABC Limited purchases 1,000 debentures from DEF Limited on 1 May 2021. At 200 Rand per debenture. The debentures carry an interest rate of 12%, but the market-related rate for a similar instrument is 10%. The maturity date of the debenture is 30 April 2026. Debentures mature at a premium of 5%. Right, so this is now interesting, premiums and discounts. So that means that if it matures at a premium, that means the future value, in the future, we will pay them a little bit more than they invested. And I'm going to show you how to do that calculation. But in the required, they say complete the general journal entry for ABC Limited relating to the information if ABC has a 31st December year end. Something that's also now very important for you to notice is look at the year end of the business versus the year of the share, right? The issuance. So this does not coincide. The financial year of the debentures and the financial year of the company is not the same. And this is something interesting that needs to be sorted out. So as part of the solution, we must first do our work on our financial calculators. So the first thing we need to do is we need to calculate our future value, which is your maturity value. And there we've said it's 200 times 1,000. So it is 1,000 debentures times 200 Rand, and then it's at a premium. So it matures at a premium of 5%. So the future value needs to be increased by 5%. So what I did here was I said it's then 200 times 1,000 times 1.05 because it's 5% more. Had it been a discount, if it matures at a discount of 5%, then the future value would be 200 times 1,000 times 95%. That would be for a discount. But in this question, we didn't do a discount. So I don't want to create any confusion. Then for the years, we have to count the financial years. And that is then issuance date until maturity date. If I look at the issuance date, it's 1 May 2021, meaning we will then have 30 April 2022, 30 April 2023, 24, 25, 26. I count 5 years between issuance and maturity, which is that 5 years. The 10% is the effective interest rate or the market-related rate. And then the payment will be our future value times the actual interest that is carried by this instrument. So this is a 12% instrument. However, the market rate is 10%. Something that is important to remember is when we calculate the payment, we ignore a discount or a premium. So you will see by calculating the payment here, I simply said 200 times 1,000 and then times the 12%. So please note how I did not include the premium. And if there's a discount, you also don't include the discount when calculating your payment. Then compute present value and I get 221,372,36. For our financial asset amortization table, I have just now gone to Amort 1. And if you look under Amort 1, I get an interest of 22,137.24. I just jotted down the closing balance, but this isn't really necessary. Right, so again, we must remember that the amortization table will run together with the issuance date. Now. So just take that into account. So the first year will be between those two dates. If I now do my journals, I'm going to start off by saying I recognize my financial asset. So I debit financial asset debentures and I put the present value that I calculated here. Under bank, I make a payment to buy this financial asset, which was 200,000. And this would be your future value, but it excludes the premium or the discount. It would just be the future value without a premium or a discount. Then the gain on financial asset exists because we have a situation where there's a premium in future. So the premium or the discount is valued in the journal separately. If it had been a discount, it would be on the debit side. Because it's a premium, we're going to score 5% in the future, and that makes it a credit, and you're going to book it to gain on financial asset, and that is a profit and loss item, and it's basically your balancing figure there. Right, then at year end, we need to recognize our interest, but year end is now 31st December. So we need to be careful that we need to adjust it for the number of months, because the shares were issued on 1 May. So we're going to count May, June, July, August, September, October, November, December. So there's only 8 months between issuance date and the 31st of December, which is year end. So that's why I've adjusted the interest that we calculated on the amortization table by 8 months. Please note how there's no bank entry here, because payment is not yet receivable. Payment will only be receivable on 30 April 2022. And I did do this calculation in purple just for any question marks that may exist around the payment, when the date when the payment is due. But for the interest at year end, we already have to recognize the interest income because we've already earned it. So this is an accrual, right? It's the accrual concept. And what happens here is we increase our interest income by 8 months, and then we put it against financial asset debentures. When the payment date does come, we're going to make our payment, which is out of our bank, or we're going to receive the payment made into our bank. So there's the payment that we typed into our financial calculator. There it is. Then we need to recognize the rest of the interest income, because between 1 May and 30 April, 1 year has lapsed, and at year end we had to recognize 8 months. So for 1 year, we had to recognize another 4 months to get to 12 months. So I adjusted the interest we calculated on the amortization table by 4 months, and I put it as interest income. So again, the balancing figure between the bank and the interest income is your financial assets, which is the debentures. So this is what the journals would look like if you are doing it from the perspective of the company who purchased this financial asset or these debentures. Suppose that we have the same example, but now we have to do it from the perspective of DEF Limited, which now makes it a financial liability, because DEF issued this debenture. We're going to have the same calculations, but just look again that the financial year of DEF is 28 February 2022. The rest of the information is all the same. So what will happen? So now we're recognizing a financial liability. So I call it debenture liability, financial liability debentures. And this will be the present value that we've calculated. We get money into our bank accounts when we issue debentures, because we give people these debentures and then they give us the money. So we put our future value, but again, the future value excludes the premium or the discount. Premium is now recognized as a loss to this company. And it's a loss because in the future, we are going to give them 5% more. So we are losing money. And it's a loss on debentures, profit and loss. And this is our balancing figure. At year end, which is 28 February, we have an interest expense now, not an interest income. And now we have to go and adjust the interest to 10 months, because we issued on 1 May. So it was May, June, July, August, September, October, November, December, January, February. So there were 10 months here up between May and 28 February. So adjusted for 10 months, I recognize my expense and I put it against the debenture liability. When payment date comes, out of the bank account, we make a payment which is equal to the payment on our financial calculators. We recognize the rest of the interest expense, which is now 2 months to get to 12 months, because 1 May to 30 April is 12 months. So we're short 2 months. So I put the interest expense there. And then the balancing figure goes again to the debenture liability. All right, so then we are on fair value, that I am going to then discuss in the next part of the video. Otherwise, this is going to be very, very long. So I will see you then in the next video, which will be part 2, and then we will speak about the other type of valuation, which is the fair value valuation. I'll see you in part 2.